Okay, good morning everyone. A very warm welcome from this panel to our audience. I'm Panos Katsambas. I'm a partner with Reed Smith, heading the financial industry group and working with institutional investors and a number of investment structures and opportunities in the shipping sector as well. Yeah, in the past years, we've run this panel at Capital Link, both here and in other locations, and always had a focus around private equity and the distressed nature of the market and opportunities for funds. And this year, I would see the title to be slightly different and touching on a broader theme around investment opportunities and capital allocation strategies. As a result, I'd say, of a lot of the distress having been cleared out, NPLs having traded, and having from a financial and investment segue a more robust and less volatile, perhaps, shipping market. On the other hand, the geopolitical situation is nothing but volatile and uncertain, and that, coupled with regulatory and environmental changes, provides an always interesting environment for the market participants and the opportunities they are pursuing. So with this background and with our panel covering pretty much a broad segment of the market, from advisory to ownership to investment management and running institutional money and invested across different parts of the shipping market, we'll be examining where the opportunities lie for professional investors and market outlook, both for debt and equity opportunities. Very brief introduction to the panel, which I assume you all know them quite well. We have Paulo Almeida, CIO of Tufton, Ole Hjertaker, CEO of SFL Corporation, Jim Cirenza, Managing Director with D&B Markets, and Christoph Toepfer, CEO of Borealis, Maritime. And I'll start this by going first to the fellow service provider advisor. Call it a bit of advisor bias. But Jim, let me start with you. Can you provide us with your view on the current market situation and where you see opportunities for your clients, and any differentiation between the U.S. side and the U.S. investors?
Good afternoon or good morning. I'll start with the U.S. picture at the moment. We finished the month of August with the average retail investor more than 2/3 invested in stocks and less than 1/3 invested in bonds and cash. Both of those are fairly extreme. We had institutional investors with record high cash levels in the fourth quarter of last year, and by the end of the summer, we're back to average cash levels at best. And we've had a year and a half of really anemic sort of ECM and DCM activities in terms of total activity. So as Christoph said earlier, I think this fourth quarter, starting with September, is going to be an interesting test for the markets. Institutions are now in a position where they're probably going to have to sell something to buy something, so you better have something more attractive than what's currently out there. So the picture, I think, has changed quite a bit. To complicate the cash flow picture as well, we've had 82 straight weeks where active equity managers have lost funds, withdrawals. And during that period of time, the ETFs have just dominated, which is great. It just keeps pumping up the biggest stocks. But the active picture has become a little bit more troubling coming out of the summer than what we saw before.
The shipping segment of the market fit into that picture, and as we're entering the fourth quarter?
Sure. So the technology exposure went from an underweight at the start of the year to being an overweight thanks to AI and amazing second quarter numbers. Technology was the outperformance in the U.S. indices for May, June, and July. Everything else, if you looked at the S&P equal weight, the year's been flat. As far as shipping is concerned, even though the U.S. ownership of shipping has improved over the last 2 years, I don't view it as an overweight yet. And for 2 years now, we've talked about everything that touches energy is doable. And I don't see what's going to change that with Brent at $90 a barrel. So for everything that touches energy, I think the picture on a relative basis is very good.
Okay, well, we'll be coming back to some of these themes later on, but let me switch to the owner side and go to Ole. And you just heard the outlook from the advisory side on the capital markets, and obviously you run a diversified listed shipping company with a long history in terms of being listed. What do you see in terms of the market outlook vis-a-vis your investors, and more generally a bit of a comment around the strength of having a listed vehicle in this sector?
Yeah, so SFL has now been listed for nearly 20 years, so it's been going for a while. It's been returning, close to 13% over the years, which you could say doesn't sound too much, but most people who invest in shipping lose everything. So getting something is actually, a big plus in this industry. So that's been good, paying dividend every single quarter, et cetera, et cetera. We have a diversified fleet. But we've gone through, I would say, a total transformation of the business we do. I mean, when we started, it was more finance-like, where we had, either, bareboats or structured bareboats, you can call it. And what we have realized over the years is that you have to be very careful with how you invest, and who you deal with and who your counterparties are. And we really switched because we wanted to deal with end users. And to do end users, you have to switch from being, call it a bareboat finance-like setup, to be more effectively fully integrated, delivering, call it the logistic services to end users on the container side, car carrier side, tanker side, etc. So that's changed. But if we look at just being public, I think my dilemma in SFL, I mean, we have $1.4 billion market cap. We have a turnover of $50 to $60 million per week, share turnover. But it's sort of in the U.S. market, it's sort of irrelevant. It's too small. I mean, you really need to be $4 or $5+ billion to be relevant. And that's a problem for most of the shipping companies. They're just way too small. And also, incidentally, I mean, most of the, or at least a lot of the shipping companies are priced under NAV, under liquidation costs. I mean, how can that be? I mean, you should be ashamed if you run a company. We're not able to persuade your investors to at least, value it at what it's worth if we sold it. I mean, then you should sell it. So that's sort of, so some of the listed entities are sort of holding on to their platform, maybe to reward themselves. Maybe, management compensation is too rich in some of these companies. Not in SFL. We have the lowest, you're getting there, Christoph. We have the lowest, call it G&A or overhead, I think in the industry per vessel day, and also per capital allocated. So some of our fellows here, they, like Christoph here, for instance, I mean, he gets his money from KKR. So if you're an investor, I mean, you invest in KKR if you're allowed in, you pay a fee, an incentive fee, and then KKR invests with Christoph, and then he charges a fee on top of that. So in SFL, you go straight in. There are no extra fees. It's super, I don't understand why people go sort of the wrong way around it. Well, what do you think, Paulo?
I think
he has both, right? He has the fund and the listed, so you can pick and choose.
We have both. There's a pretty good British term, horses for courses, the American version, different strokes for different folks. People have different ways to access the markets, and some investors don't feel comfortable enough choosing someone to deploy capital for them in shipping. They want someone in between that, that's, I think it's just a matter of life. Most of the private money that we manage is directly for European pension funds, and we have 2 listed vehicles, Tufton Oceanic Assets, which Tom from LSE mentioned this morning, which I've talked about before in these panels, and then in March we listed a vehicle in Norway, a market maybe more familiar to you, Ole, and the Fredriksen, next Fredriksen universe. And we're pretty transparent on our public vehicles. I'm not going to go into details on that, but clearly our investors are pretty happy with that. And in fact, as we've discussed before, we both have Fidelity as one of our biggest investors in our listed vehicles.
But you're listed in London. I mean, what's sort of the attention? What kind of share turnover? Is there liquidity? I mean, if you're a big investor, I mean, you want to make sure that you can get in and out without moving the share price. So if you want to sell your shares, you don't want the share price to crash because you sell, say you need to invest $20, $30 million, and you can say you can maximum buy or sell 10% per day to get in and out. I mean, in I'm saying generally, most of the shipping companies have really thin liquidity and they're uninvestable for institutions.
It depends, again, horses for courses, as they say we say in the UK.
I take the brewery horse.
Sorry?
That's my favorite. The horses for courses.
Yeah. So, in the UK, as Tom actually briefly mentioned this morning in his presentation from the LSE, there is much more of a universe of alternative investments in funds that have some liquidity, not particularly high liquidity, where investors look to support a strategy that is more akin to a private equity type strategy, but through a listed format over a 7 to 10 year period. And in fact, one of the interesting aspects of a lot of the funds, it's one that we in our London vehicle have, which is we think is very investor friendly, is on the 7th anniversary of the fund, and then every 3 years after that, and our 7th anniversary is coming up next year. Investors get to vote whether or not we should liquidate the portfolio. And so, clearly we feel very confident in our investment strategy that our investors will support us, but it also provides, a bit of mechanism that if something does go wrong, which, can happen, and it's good for lots of funds to have this, that if the investor says, you say your portfolio is $1.25 per share NAV, but we want to see that $1.25, you have 2 or 3 years to sell the assets. We think that's great discipline to have that. We don't think our investors will ever tell us to sell assets. We'll choose when to sell them and to return capital, but it's nice to have that discipline. It makes investors more likely to invest in the first place.
But they're locked in for 7 years, effectively. Is that what?
No. They can sell.
Yeah, but is there liquidity to do that? I mean, okay, maybe, yeah. But Christoph, I guess, is that you have more permanent capital. You have locked-in investors, don't you?
I can give you more detailed advice on the structures of closed-ended funds, but perhaps we can move on to Christoph also to hear what he's been doing right for KKR to be supporting him and the Borealis team for so long, and where you see the opportunities in the current market segment.
Thanks, Panos. It's always good to be on a panel with Ole because he starts running the panel and tries to see some controversy. And yes, of course, we take some fees. The fees keep our lights on and pays for the rent. But I asked the audience, who do you rather invest into? Someone who only makes money if you make money, or someone who gets the bonus at the end of the year? So we have a very different business model than obviously than Ole. We deploy institutional capital. KKR is one of our investors, but we also have others. And we have been very opportunistic around which sector we pick and how we deploy the capital, and also how we exit. With the shift in the market and the years that we've had, we have been very, very disciplined around exiting also. We have sold over 60 vessels in the last 2.5 years. We've reduced our fleet from 80 vessels to now 25. So we've also bought a few vessels. We've bought into the offshore market. So we have also delivered a very disciplined approach around really taking the profits when you can take some profits. Yes, of course, in hindsight, some vessels we sold too early because the market went further than we thought. We had a heavy investment in the container side, and the container market obviously went further than anyone had predicted. But it's important that you also actually show that you are actually exiting and taking the profit, and you're showing the investor that you're disciplined, not like what happened in the German market where the manager always hang on because of his management fees, because there was no alignment of interest. So alignment of interest with the investor is really key for what we do. We have, in the last few years, transitioned the business into the offshore market, but also now there's a further transition, and Philipp Wünschmann mentioned this on the previous panel, that opportunistic investments right now is tough in shipping. Everything is expensive, even offshore is expensive these days, and it's very difficult to have an opportunistic approach right now. If you're purely opportunistic, you probably like at Battery suggested, buy your Sunseeker and take some long vacation, because there may be taking some time before you see opportunistic interesting deals again. So we are also looking into investments these days that are much more conservative, more with long-term cash flow secured, where you're actually able to de-risk your purchase price sufficiently that you are actually ending up at a residual value that's defendable, and that is taking not too much risk in this market right now. So we have to reinvent ourselves from time to time. We go with the market. We don't count ourselves with assets under management as being the success. For us, the success is our track record.
And let me ask you in terms of, and I think that was the theme I mentioned at the beginning of this, that those opportunistic investments are appearing to be scarce these days in the industry. But in terms of the more structured investments, cash flow positive and so forth, in which segments of the markets do you see greater opportunities right now and you guys are looking at?
It's quite clear that the tanker market still has some opportunities. We see some opportunities in some older container vessels sometimes. The dry cargo market will be too expensive right now. The cash flow is not there. We see opportunities in the offshore market for sure. That is a market where we continue to deploy capital and see opportunities. It's obviously a market where not everyone can play in. We could touch on ESG later on as well, probably. But it's a market that is underinvested from an institutional capital perspective right now.
Ole, I want to come back to you, and you mentioned earlier about the size and where you need to be relevant, perhaps in the U.S. market from a liquidity standpoint for the institutional investors. What is holding the listed shipping companies from trying to use their share as a way of consolidating the industry and growing bigger? Do you see opportunities in the current market segment to that effect?
Absolutely, there are opportunities if you have the right pricing and if you run your business efficient enough. So, as I said, most of the shipping companies are inefficiently run. They're priced, call it under liquidation value, and then it's of course very difficult to use that as a currency in doing transactions, because then you're effectively diluting yourself if you're printing shares to do a deal. So if you have the other side around, then it's a bit different equation. And I happen to be on the board of Frontline, and Frontline is a good example of a company with size, almost $4 billion market cap now, with around $200 million turnover. It's like 4 times SFL in daily turnover on average. And they have a pricing that, arguably, you can talk to a broker, NAV is sort of it's a topic in itself. But at least it's decently priced, which means that you have a proper currency. So I think that's the issue. For some of the listed companies, they don't do anything with it. And they can hardly attract the investor attention. The smartest guy is really this guy, because he collects the M&A fees and the listing fees, and he runs, takes the money and runs. Don't you?
He's the next to be asked on this subject, but Jim
I can still run.
Jim, your views on potential, M&A activity in the sector and what's holding it
Sure,
back?
and I'm gonna jump on the back of the comment about Frontline. Frontline's listed in Norway. It's listed in the U.S. I'm a big fan of dual listings. I was up here 12 months ago with the LPG stocks. You should have bought those. They doubled. Anyway, even BW LPG just announcing last week that they have an intention to dual list in the U.S. The stock went up about 10%. So there is a listing arbitrage. For the last 12 months, if you're listed in the U.S., you've got a deeper pocket of shareholders, combined with the fact that what I mentioned earlier, there's just a ridiculous amount of ETF money over there, and if you can get yourself in certain indices, the difference between a U.S. listed company with $7 or $8 million of daily volume and $1 billion of market cap, you're in a situation where you could probably have more than 20% of your shareholder base as passive investors, and investors are cumulative. So there is a listing arbitrage. So getting back to M&A, M&A has really dried up in the last 4.5, 5 quarters. We've had across the industry the 4 worst quarters in a decade in terms of M&A activity. Cash M&A has absolutely collapsed over this period of time. That being said, there is some M&A activity in shipping. I think you described the dynamics well enough. I don't need to go through them again. We've certainly seen situations like LNG over the last 2 years, to a large extent, being taken private. So we'll talk about that later. But yeah, is M&A going to continue to be a feature in shipping above and beyond the market overall? I think so.
Paulo, coming back to you and Tufton's listed vehicles, what is you touched a bit earlier on the kind of exit approach and the renewal of the investment term, but what other differences would you see from a normal listed shipping company and then from the private funds you run, and what's the driver for launching these products?
Well, so if we look at our London listed fund, the genesis of that is an investment community here, primarily in the UK, that wanted to diversify away from high exposure to real estate, a little bit of aircraft leasing, and infrastructure. So those were asset classes that historically have been highly successful, but where yields were very low, asset values were very high. And we've seen this on the private side as well. Again, primarily pension fund money, both smaller pension funds via our UK listed vehicle and private pension funds through separate accounts. So shipping had seen nearly 10 years of pretty poor performance after the global financial crisis because of the overhang of capacity, and there was a recovery coming, and cash yields in general were much more attractive than in those other markets where you were getting 4.5%, 5% in shipping. If you have a pretty risk-averse strategy like we do, Christoph does too, and so does SFL, Ole, you're probably around the 11 to 12% over the cycle. If you have a diversified portfolio, 2 to 3 year contract, we presented a lot of historical data on this. You're probably producing 12% unlevered cash on cash. That's pretty attractive in a market then where you were getting 3.5% on real estate, 4.5% on infrastructure. And then clearly the markets have corrected, however. We think dry bulk is probably more attractive in the next 6 to 12 months than it has been in the past 6 to 12. Totally agree with Christoph that the yields are not attractive, but a lot of our best transactions at Tufton have been investing in segments with asset values at 30% discount to new build parity that were yielding low, but where we saw either good demand drivers or even better, good supply drivers. So we think that will come back, but agree as well that tankers are expensive by a number of measures. Yields that you can lock in versus new build parity versus history. So we've been looking a little bit more at niche markets. We listed a chemical tanker portfolio in Oslo in March. We're looking more and more at dual fuel vessels where we would have 5, 7, 10-year charters. So again, a risk-averse strategy, and where there is capital looking to support shipping's decarbonization, and we're looking more and more at offshore wind as well.
Got it, and we'll come back to that, some of these new types of vessels, but I want to switch gears and ask Jim to comment on the current status of the the debt markets in shipping and the financial institutions providing debt to ship owners, and we've seen a lot of change, shrinking of the market. What is the status of banking right now from a lending perspective as opposed to advisory?
In the U.S., I got a fixed income business and an equity business. In 2023, thank God I've got a fixed income business. Offshore has been enormous this year. It continues to be enormous. You know, everything that touches rigs, including offshore vessels, you know, most of these companies have come out of bankruptcy and restructuring with little or no debt, and so they've had the opportunity to make acquisitions and lever up a little bit to levels nowhere near what the levels were previously. We did a Tidewater bond back in June. We're doing a Stolt-Nielsen bond today. We did a Valaris bond just about a week or two ago. We're absolutely busy as can be with the offshore-related segments. Beyond that, from an equity point of view, we had the Himalaya IPO earlier this year. We had a Bore Drilling convertible bond. So shipping hasn't been absent from our activities, but once again, this year has been driven by our debt activities, and I'm sure everyone can kick themselves that we should have been, you know, they should have been doing this 12 months ago instead of this year. But you know, central bank rates are higher, treasury rates are higher, but we haven't gotten into a situation yet where we've seen a significant widening of high yield relative to those treasury yields. And so as crazy as these current rates may sound, I still think there's a risk that we're going to go wider with the high yield pricing over the next 6 to 12 months.
Christoph, you guys have also launched a specialty lender in the industry. Obviously different, perhaps, approach from the more traditional fixed income strategy, but where do you see the opportunities for Australis in that space, and where do you see the banking sector that you perhaps compete with? We've seen also other specialty lenders being active in the market. How do you see the lay of the land on that front?
Yes, we as Borealis, we launched a debt financing business, Australis Maritime, about 5.5 years ago, and this was a complement to what we were doing with institutional capital, seeking opportunities in shipping, and there was certainly appetite from the institutional capital base that we were dealing with to also deploy capital in this form. As an alternative lender, you generally, obviously less or unregulated, you have the ability to structure your loans slightly more, aggressive or slightly more advantageous to the way the market is working. And what I mean with that is that, for example, we do longer durations, we do higher leverage. We also have obviously a very strong view on the market. We were able to structure loans back in 2021 on the tanker side where we did not have fixed amortization to start with, but a cash sweep. So we were trying to cater for the lower earnings environment, but we had a positive underlying view of the tanker market. We also went very early into the offshore market on the lending side, again, also driven from our overall view on the offshore side. On the equity side of the business, we also then were probably the first one of the alternative lenders to also lend in offshore. And have done quite a number of deals actually in the offshore market. So it's we are complement to, or the alternative lenders are complement to the lending space. So we are working quite often with banks as well. We're taking back leverage from some banks, but also we are generally quite often working closely with banks. Sometimes we compete. Not many times, but occasionally we have lost a deal to a bank that was willing to drop the margin to some very, very low levels. But in general, our capital, with the flexibility that we can provide, and then also with the interest rate environment that we have today, is actually quite attractive capital because we are a fixed return-oriented lender. So we did not have to raise our financing costs along the SOFR curve, but where today our capital is actually just, I would say, marginally more expensive than what a traditional lender would charge. But we have the ability to be non-recourse lending, flexible in the structure. And yes, of course, some markets are a bit more difficult right now to lend into. The dry cargo market is difficult to lend into because as the prices are high, revenues are low. But again, we have an overweight on the OSV market and maybe tankers right now. We've done some fantastic deals on the container side, on the lending side in 21, 20, and 20 and 21. That turned out obviously very, better for the equity than for us as a debt provider, but also for us it was a really successful investment. So we have to transition from sector to sector and be opportunistic, be fast on our feet when we see opportunities, also in terms of execution. That's obviously a big advantage that alternative lenders have as well. So it's an interesting space. It will be there, if the market is full of cash right now, it is what it is, the deal flow is still there, and we're in for the long game.
Ole, Paulo, a brief comment from you on the debt side and how you see the markets right now in terms of getting financing for your opportunities.
Yeah, I mean, back to the listing sort of question or topic, I think being listed means that we probably have better access to alternative capital, like, one thing is bond loan. You can also do that as a private entity. I think you get a little bit more attention, wider distribution if you're public. You can do convertible loans if you have a reasonably priced, capital. And you can do equity, right? So there are different sort of pockets of capital you can tap. Or, what we try to think like a fox. You always need the second way out. So we always look at various capital sources when we fund our business. We have, just as an example, when I joined SFL, it's now, too many years ago probably, we were predominantly funded by Scandi banks and European banks, but mainly Scandi banks. Now, if you combine all the Scandi banks in our portfolio, they would be our 14th largest bank. We have many good friends from other institutions who we are doing a lot more business with here. And we've done a lot in Asia. I think last year we funded, around $1 billion in Japan alone. So that's been definitely a sort of a change. Why is that? Maybe I'm throwing sort of a little bomb in. Maybe that Poseidon Principle thing has distracted the banks to a certain degree. Now as the wider, call it, industry, both IMO, they have the European Union and others who are sort of effectively catching up and maybe going ahead, maybe banks sort of realize that, well, you shouldn't scrap. I mean, you really need to finance ships through their life cycle. You shouldn't, own it for a few years and then scrap it. That's very bad for the environment, particularly because you have to sell it to somewhere who had to melt it down. You cannot really reuse it. You cannot put it up on a beach in India or Bangladesh where they actually use everything. Not good for working conditions, obviously, not good for pollutions around it, but it's a different type of recycling. But now that is changing a bit, and I think it's very, very positive with the new focus on well-to-wake. Because when you look at that, we spend a lot of time on this for obvious reasons, right? With a portfolio, and we want to be service providers for logistics, larger logistics operators. And when we look at it and you study it, you see that shipping is probably the last industry that should be green. You should do everything else before you use that energy on shipping. Yes, you will modify ships, you will optimize ships, put new paint, new bow. You can do a lot with ships to make them marginally better, but you really have to do a lot elsewhere, for the greater community. So that is something that we both spend time on. When we look at investments, of course, when you have more uncertainty on how banks act. When banks try to pull the rug under you, as we felt that they've been doing from time to time in certain segments, you have to be a little careful. Maybe you won't, you have to, do your deals a little different if you don't have properly, what can we say, predictable, partners also on the financing side.
What did it cost to hedge the yen?
We don't. We do straight dollars. Yeah.
Paulo, from your perspective, access to financing and the state of the market in that respect?
Yeah, we're not a big user of leverage, but definitely our listed vehicles are much more straightforward to get bank financing for, and in some cases we've been looking increasingly at private placements for ships that have longer than 5-year charters, where we want to have a tenor of debt equal to the tenor of charter. But definitely the listing is very helpful because it's a corporate entity that, even if it doesn't give a guarantee, it has an audited track record, et cetera. So the listing helps a lot. As it happens, our private investors have not wanted to use any leverage because they own all sorts of assets with no leverage, including real estate, which is, let's just say historically is seen as an extremely safe asset. Maybe people feel a little bit differently over the past couple of years, but if you're a pension fund that has $10 billion of real estate with no leverage on it, they're not about to put leverage on ships that have 2, 3, 5-year charters. So it's worked very well for us, but definitely a listing helps a lot. It's a lot better than trying to put leverage into a fully private structure.
Before we close, and I see here the timer running down, but I wanted to ask each of you for some thoughts around the broader geopolitical situation and the impact of sanctions in your opportunities and the investments you run, and how, if at all, has impacted your day-to-day. Ole, maybe we'll start with you.
Oh yeah, absolutely. It affects us a lot, and we have a sanction team in our organization who is spending a lot of time on this. Of course, it's become. We've always had sanctions, call it, in our industry, and that's one of the big benefits, I would say, in addition to counterparty risk, that counterparties go bankrupt. If you charter vessels to intermediaries and you don't charter to end users. Chartering to end users who are actually, use and want cargo transported, they are as exposed to sanctions as we are. So we are, you can say, from that perspective, cooperating. But it's difficult. For instance, you look at Russian oil. If it had been sanctions altogether, it would have been very simple. But the problem is that, the world needs the Russian oil. So therefore you have these price cap and these various measures. So we've had on vessels that we have chartered out to, large, oil companies. If everything checks out on the sanction check, we're not allowed to refuse lifting the oil, even if we didn't want to do it. It's but again, we focus on it. We know all our banks do that, or all our insurers do it. But more importantly, as long as our customers are aligned with us, I think. But we need to do our own job, of course, on that. But it's quite intensive. We spend a lot of time on that.
Christoph, how is that more aggressive regime impacting a kind of institutional manager of money in the space?
It's the same probably for everyone, where the sanction compliance is a big topic, and also investing US based private equity money obviously very much is the forefront of what we do as well. It takes a lot of time in our team. The requests from clients where we provide lending to, with the Russian compliance trading, etc. So it's a very time intensive work. But it needs to be done, it's quite successful, and generally we have a if everything checks out, as Ole just said, then you cannot stop the clients going there. We don't go to Russia or to any Russian trade with our own fleet. We just have ruled that out, not even for compliant cargoes. In general, obviously, the geopolitical landscape is something that affects us in shipping all the time. We've had major events with COVID and with the war, both of which had major effects on certain parts of the shipping market. And this is how it will continue. I think there's generally quite a lot of optimism right now around every sector. Will do well. Maybe containers have a bit of an order book to work through, but also there, through the decarbonization and slower speeds, some people are optimistic that actually the order book can be quite easily absorbed. But our view is also on generally as a firm, something somewhere will break, and there will be opportunities again for us to deploy also opportunistic capital. And in the meantime, one has to be disciplined, rigorous on your lending side around sanction compliance, and make sure you don't trip up anywhere, getting caught in a wrong sector or with a messy situation.
Jim, let me close it with you. Any last remarks on the geopolitical situation, very briefly?
Sure. I mean, listen, we're a bank and we're an investment bank in the U.S. We're a bank and we're an investment bank here in London. The amount of regulatory scrutiny that we get is enormous, much more than an investment bank, for instance, would receive. Christoph talked about the head count of compliance in London. Thank God they win. We don't have 30 in the U.S., but the pressure that we get to know our clients, KYC, and the pressure that we get to underwrite clients that fit what we preach, there is enormous regulatory scrutiny. The amount of time that regulators spend with us when they do their examinations has tripled in the last decade. So we're well staffed on that front.
Great. Well, thank you all very much. Nicola, Olga, thank you for having us. Hope you all enjoy the rest of the shipping week, and thank you to our panelists for a wonderful discussion.